Hi class, welcome to Chapter 3, Participating in Marketing. Like yourselves, I'll be teaching this class from the comfort of my own home. Okay, learning objectives for today. Describe how an investor goes through the process of buying and selling securities. Explain the difference between cash and margin accounts. Describe the types of trading orders that can be executed. Explain tax implications of various investing strategies. Understand how to measure the performance of securities in various markets through the use of market indexes. Another name for that is benchmarking. Benchmarking is used to judge performance. A lot of times we don't judge performance based on an absolute term. By an absolute term, I mean, did the market return 5%? Did the market return 15%? Did it lose 10%? Sometimes that's kind of irrelevant. The important thing to note is, how did our portfolio do compared to the market? If our portfolio lost 10%, but the market lost 25%, we're up 15. You know, it may not look good on your bank statement being down 10, but if the market's down 25, technically you're still up. Okay, so participating in the market, what does that mean? We're just talking about the, buying and selling securities, stocks, bonds, etc. Okay, just repeating a lot of the same stuff that was on the previous slide. We'll move on. Okay, buying and selling in the market. Full service brokers. Examples of that are Merrill Lynch, Morgan Stanley, Smith Barney, and UBS. Brokers determine objective. Brokers help determine the investor's objective. Okay, what is the investor's objective? Are they conservative? Are they looking to preserve capital? Right? Are they looking for income, growth plus income, or just growth? So if you're in between the ages of 20 and 40, chances are you're looking for growth. Right? You're trying to save for retirement. You're trying to get to that level where you are then concerned with income. Okay? Growth plus income could be towards 40s, 50s. Once you're in your 60s, 70s, you're concerned with income, and towards the end of the life, you may be just looking to preserve capital. Or, if you don't care about your family, you might not be interested in conserving anything. You might just want to spend it all, right? Okay? And then lastly, that last bullet point there, risk versus expected return. We can take on more risk. Ideally, when we take on more risk, we're hoping to do what? We're hoping to get a higher return. But that's not always the case. We could also take on more risk and have the potential to, lose more money. Currently, one of the riskier investments I'm involved in right now is emerging market debt. So, bonds based in, Brazil, China, India, and Russia. They have a very high return. But, those countries historically have higher default rates than, let's say, the U.S. But the U.S., if I bought U.S. bonds, the U.S. bonds don't return anywhere near as high as a emerging market bond. Okay. A little continuation here. Discount brokers and online brokers. This is actually what I use. Like E-Trade, for example. What are they known for? Low commissions, stripped down service. They're not offering a whole lot of advice. A broker might sell you, his expertise and his advice, while an online broker isn't doing that, at least not really. They might have some additional services that are more automated, not personalized, but stripped down service, no investment advice, and communication is usually by email. Okay. Cash or margin account. So, really simple, straightforward. Cash account is you have the cash in your account, you buy the security, right? Margin account lets you borrow against your account, okay, in order to buy more. Now, there's going to be several slides here that I am not going to go through in detail, but I have a good analogy that will explain margin, okay? And the margin investment most of us will, or hopefully most of us will probably buy in our lifetime. That margin investment is a house, okay? So let's say we are looking to buy a house. Hypothetically, this is not the case anywhere around here, but let's say we buy this house for the selling price of $100,000, okay? How much are we going to put down on that house, okay? Let's say we have $5,000 to put down on this house, okay? We put $5,000 down on this house, it's a $100,000 investment, Okay, we now own this house, along with the bank, of course, for $5,000. We have a $100,000 asset we purchased for $5,000. Okay, now, let's say a year from now, what happens? Okay, a year from now, we are able to sell the house, hypothetically, for $110,000. Okay, we sell the house for $110,000. What is our profit? Okay, think about that for a minute. Okay, minute's up. We actually got a 200% profit on our initial investment. There was only a 10% appreciation on the property, but because of the margin involved, we only had to lay down $5,000 to get a profit of $10,000. That's the whole concept behind margin investing, right? Now, let's say we bought that house with cash. Okay, we just paid off the house on day one. We had $100,000 in cash, and we bought it on day one. That scenario would be a lot different. Why? Because a year from now, we would have still sold it for $110,000, but our profit would only be 10%, because we had to use $100,000 in assets to achieve the 10% profit. Now, I'm giving you a positive example here. There's also the downside to this. Let's say we buy that $100,000 house, and the value drops to $90,000. In a margin account, it wouldn't happen. It would start making you basically would be at zero the second you lost $5,000, right? So you are taking on a very high risk, because if that property you bought dropped to only $95,000, suddenly you're wiped out, because the margin in your account is gone. Okay, that's the whole idea behind cash accounts versus margin accounts. Sometimes it's not a bad idea to have a margin account as long as you manage your risk. Most accounts will only let you will make you post a certain amount for the margin. You won't be able to do like a 95% margin like you could, let's say, on a house. Okay, but if we're in a bull market, there's an incentive to have a margin account. There's some interest involved in using margin accounts. It's usually minimal, but you just want to be aware of that. Okay, moving on. Okay, so we're just going through an example here. You purchase 100 shares at $60 per share, and the margin is 50%. So 100 shares at $60 per share is $6,000. Okay, borrow is cost multiplied by 1 minus the margin percentage. So it's minus 3,000. So equity contributed. So all we need to do to buy $6,000 worth of securities is have $3,000. Okay. Next, assume the stock price rises to $80 per share. Okay. We now have $5,000 of equity. Okay. What is the return on initial investment? Increased equity minus initial investment over initial equity. So 5,000 minus 3,000 over 3,000, we had a return on investment of 67%. I will ask you this question on a quiz, so just be prepared for it, and a very simple and straightforward formula for you. Okay? This is just giving a quick example of what happens when a stock drops. Okay? Same thing here. Formula is the exact same thing. Decreased equity. So really, instead of calling this increased or decreased equity, we could really call this change in equity. Okay? Long or short? That is the question. So if you're long, you're buying stocks. Okay? Profit expected from increase in price. If you're short, profit from expected decline in price. You're selling stocks you don't own. This is a tough concept to kind of grasp. How do you make money on something you don't own? For this class, I want you just to understand the concept of when you're selling short, you're making a bet that the value of the asset is going to drop. Okay, that's the important thing to know. You sold short 100 shares at $70 per share, and the margin is 50%. So this is kind of using more than one example from the text. Now we're combining two theories. Okay, if the price of the stock increases to 80, what will be the new value of your equity position? So this is a bad example. Well, it's a great example, but it's bad if you're the investor, because you bet the stock was going to go down, right? Also, you use margin. So you're in a really bad position here. You bet the wrong way on this one. So your initial margin equity is $3,500. You lost $1,000. Your current margin equity is $2,500. That's not a good sign. Okay. Types of orders, market orders. This is generally when I ever place a trade. I usually make a market order. I'm not trying to time the stock for a market. I'm not trying to because I work in the investment industry, I'm very restricted in terms of what I can buy, what I can sell, and when I can buy it and when I can sell it. I have to notify my company whenever I'm buying or selling something, and I generally have to hold on to that security for 60 days. So that makes it a lot more difficult for me to invest in individual securities. I'm really a macro investor at this point, meaning I traditionally use only ETFs because they're less restricted for investment professionals. Why do they do that type of stuff? Mostly just to prevent fraud, and I'm not some Wall Street big shot at this point, but if I knew my company was buying a massive amount of a certain stock, I could buy it before they did, and then when they bought it, I would be able to kind of ride the wave of the rising demand for that stock and then make an easy profit. So they take steps to prevent you from doing that. Limit orders, you pay no more than the limit price. You're just setting it. When selling, you receive no less than the limit price. So if you're not going to be in front of your computer or next to your stockbroker, you can set these limits. Like, all right, if it hits this, I want to sell. If it hits this, I want to buy. That's basically the concept behind that. A stop order becomes a market order when the objective is achieved. When buying, placed above a current price. When selling, placed below a current price. Types of orders. Day orders expire at the end of the day and good till canceled. So if I had a limit order and I wasn't paying attention to my investments on a day-to-day basis and I wanted to protect myself from a large loss, I might make a, going back one slide, a limit sell order of $80 on something that I bought for $100. Why would I do that? And I would make that good till canceled? Well, because if I'm not paying attention to that stock every day, I might want to just have a safety in place to say, all right, let me just have this safety in place, so I'll sell if it goes below 80. Okay? Cost of trading, the highest cost of trading is at the top. Full service brokerage, Merrill Lynch, Morgan Stanley, discount brokers like Charles Schwab and Fidelity, they'll offer some advice, and online brokers, TD Ameritrade and E-Trade. We see here the differences in a typical commission. Okay, full service brokerage, 2.5%. That basically means you need to have a good amount of money invested in order to make this reasonable, right? Discount brokerage, very small amount of commission, and then an online broker, very minimal amount of commission. But guess who's doing all the research? You are. Okay. Other factors to consider. Degree of sophistication of the investor. All right, if you're not sophisticated at all and you're just buying stocks because you like the company itself, there's a big difference between a good company and a good investment, right? And you could have a lousy company that's a great investment. For example, Sirius Satellite Radio, probably not the best company in terms of a balance sheet, but from 2007 or 2008 to today, the stock went up like 2,000%, right? Does that mean it's a great company? No, but that means it was a great stock during that time period. Okay. Degree of complexity, you might be concerned with capital gains, potential merger offers, retirement planning, estate planning, all that stuff. The more sophisticated you are, the more advice you want, the more expensive it is. All the above may outweigh the savings and commissions. So, a lot of people are moving towards private wealth advisors, which charge higher commissions. But if you're, concerned with your wealth, or lack thereof it, I guess, right? You might want to use a private wealth advisor in order to get that, personal touch. But it's going to cost you a little bit more money. Is it worth it? It depends how sophisticated you are. The merits and drawbacks of internet and online trading. The pros, you have all the information at your fingertips. Okay. The cons. You need to know a lot more about accounting, finance, investment, economics, tax, legal issues. Tax Act of 2003. I'm not going to really focus too much on this, but legal advice provided only by CPA or CFA. CPA or CFP, Certified Financial Planner. Tax considerations could outweigh savings on brokerage commissions. Calculating the marginal tax rates. Example, single taxable income is $40,000. How much is your tax obligation? Might be a little hard to see here, but we're giving the different tax rates. Are you familiar with how the tax system works in the U.S.? We have a progressive tax system. So what it's saying right here is if you make between $0 and $8,500, that first $8,500 is taxed at 10%. From $8,500 to $34,000, pretty wide band, it's taxed at 15%. But from $34,000 to $83,000, approximately, it's taxed at 25%. $83,000 to $174,000, 28%, etc., etc. Okay, changes with marriage. The bands get a little bit bigger. Okay, so that means if you are making $175,000, you're not getting taxed at 33%. You're only getting taxed at 33% from $174,000 to $175,000 approximately. And we're seeing the math done right here on the side. Okay. Calculating average tax paid. So taxes paid over taxable income. That's how we get the taxable income. Okay, and it's bringing this right here, the 6,480 over 40,000 to come up with the taxable income of 16.2%. Okay, capital gains and dividends. Capital gain or loss occurs when an asset held for investment purposes is sold. Assets held for more than 1 year. Long-term capital gain, the max tax rate on that is 15%, and that includes dividends at this point. There's a big political issue right now, and at some point, hopefully my videos are updated, but that tax law could change. A lot of the people on the left, I believe, want the dividend tax to be higher, because who typically is receiving dividends? Typically, the majority of people receiving dividends are wealthy. Now, you could have the argument saying, well, what about people who are in retirement, and et cetera, et cetera. I'm giving you a general rule here. As a majority, the wealthy are receiving all these dividends. The common folk, the people who don't have as much invested in the stock market, aren't so concerned with dividends. They might get some dividends, but they're not living off their dividends, as, let's say, some very wealthy person who just can invest in some dividend-paying stocks and live off that. Okay. Short-term versus long-term capital gains. So we're just seeing the tax effect. Okay. If your holding period is only 6 months, and you have a profit of 10 grand, you're going to have to pay a tax of 35% on that, which is $3,500. If you hold that for 12 months, you're only going to pay 15%. Now, on paper, you're like, well, why not hold everything for over a year? Well, there's risk of, is that profit going to hold? Is your profit going to go up or down? Now, if I believe that this profit could drop, I might say, hey, I'm taking the money and running at 6 months. It might not be worth holding on to this for the full year and worry about that increased volatility. Some of you might say, what do you mean? What's volatility? Volatility is the kind of risk of up and down movements on the stock. Some stocks are very volatile. They could be at $1 one day and $1.25 the next. In real terms, it doesn't sound like a lot, but that's a 25% swing. Okay, measures of price performance, market indexes. So we have the Dow Jones Average, Standard & Poor, Value Line Average, and other market indexes. Let's dig a little deeper on this. Okay. Wow, we can barely see this on the screen, but you have the PowerPoint slides. It's just giving you a breakdown of different indexes here and their values. What are indexes? They're just a benchmark for performance. Okay, let's continue. Whoop. Okay, the Dow Jones. The Dow Jones, we hear about it more in the news than anything else, but it's actually the least comprehensive and least relevant index. Okay, it only has 30 large companies in it. Serves as a measure of the entire market. Do 30 companies represent the entire market? Well, probably not. However, statistics will tell you that a good enough sample size is 30 units of whatever, and you can do your own research on this later. So it is representative, but it's not perfectly representative. Okay, there's other indexes here, the Dow Jones Transportation, the Dow Jones Utilities, that are just other indexes that we don't hear too much about. This is the one we hear about on the news. So when they say the Dow went up, 1%, it's talking about the 30 largest companies in the U.S. Okay, here's a little list of the companies in the Dow Jones Average: Alcoa, American Express, Boeing, Bank of America, Caterpillar, Cisco, Chevron, DuPont, Walt Disney, General Electric, Home Depot. Okay, the list goes on and on. And this list can change. The 30 largest companies in the U.S. can change. Okay. One example I'm not seeing here, I don't know when this list is from. Apple's not here. Should Apple be on this list? Some might make the argument that it should be, right? Okay. I could go on off a little tangent here. Apple's performance has been doing fantastic at the time of me recording this video. And while, because a lot of these indexes that we're going to talk about are, market cap weighted, basically, if you're a bigger company, it counts, has a greater effect on the index, right? Joe's Pizza stock, which is probably fictional, shouldn't and won't have the same weight as Apple, right? Because one's a very large company and one's not. So a lot of times the market has been doing really well at a glance because Apple's been doing really well and it's accounting for such a large portion of the market weighted index. So you can have instances like that where one company is, pushing the markets higher or lower. Okay, S&P 500, very common index. 500 largest companies in the U.S., widely followed by professional money managers and security market researchers. So you're going to use the S&P 500, let's say if you're trying to measure your performance against a, domestic equity fund, right? That would be your standard benchmark, or could be your standard benchmark, okay? Comprised of more than 75% of market value of U.S. equities. So what it's saying there, if you're reading between the lines, is that the largest 500 companies in the U.S. actually account for 75% of the market value of the U.S. equity market. Interesting statistic. And it's value weighted, right? So if your company's worth more, it's going to have a higher weight in terms of calculating the performance than, let's say, a very small or a smaller company, on that list. Other Standard & Poor's indexes, okay, the S&P 400 mid-cap, composed of the 400 middle-sized firms in which the market value between 1.2 and 9 billion. S&P 1600 is companies smaller than the mid-cap. And then we have the S&P 1500. So that combines, real easy math here, guys. The S&P 500, the biggest, the 600 in the middle, and the 400 small caps. Okay? So if we say, and this is a question I think in your homework or the quiz if you want a hint, the S&P 500 is outperforming the S&P 400. If the S&P 500 is doing better than the S&P 400, we can say with confidence that large companies at this point are having a better day or performing better than small companies, and vice versa. Okay, value line average. 1,700 companies from New York Stock Exchange and the American Stock Exchange and the NASDAQ. Okay? In these indexes, they are equal weighted. So, regardless of the market price or total value, these companies and these exchanges are equally weighted. Okay? Equal weighting more closely conforms to portfolio of individual investors. Okay. Other market indexes, Wilshire 5000. The Wilshire 5000, I know this is a homework or quiz question, is the most comprehensive market index because it includes just about every single security in the market. Okay, about 5,000. Okay, Russell 2000, 1000, and 3000 function similarly in terms of the S&P 500, except they're bigger baskets. Okay. Again, repeating what I just said here. So no sense repeating what I just said. Okay. International stock averages. So a lot of times the MSCI EFA is a very popular international stock index, and it can be broken down, customized, as it's referred to in the industry, by different countries, different sectors, different regions in the world. Broad market indicators, mostly traded over the counter by financial institutions. Bond prices are affected by interest rate movements. I said broad market indicators. It's bond market indicators. Interest rates result in falling bond prices and vice versa. Okay, let's talk about this for a second. Okay, if the market rate, let's use a risk-free rate, assuming there's no risk, is 5%, right? And then I make a loan to you at 5%. We're assuming everyone's risk-free, right? And the loan is for $1,000, right? All things being equal, $1,000, 5% risk-free rate, you're getting the loan at 5%, we're locking you in. Let's say the next day, for whatever reason, the risk-free rate has dropped to 3%, right? Your loan that you're paying 5% interest on is going to be worth more than the market rate, which is the risk-free rate. So since it's worth more, the bond is going to be worth more, because this bond is paying above market interest. And when the bond is paying above market interest, which is, in this case, the risk-free rate, it's going to be a more valuable bond. So you'll pay more money for a security that's going to pay a higher interest rate. Make sense? If not, email, we can talk about it. Okay? Bond indicators, we won't go over this. Mutual fund averages. Mutual funds preferred choice of investment for many investors in the U.S. and worldwide. This is covered more extensively in the next chapter, but it's because of professional management. You're not picking stocks. Mutual funds are generally actively managed, and you're paying somebody to pick the stocks for you. You might want to pick several mutual funds. Why? Just to diversify. One investment company may not have all the best ideas. Okay, broken down into various categories to compute measures of performance. Starting point of measurement period is very important in determining relative performance. Okay, direction of indexes. Direction of indexes are closely related. So if we see the S&P 500 go up, chances are the Dow Jones went up. Chances are the Russell 1000 went up. They're closely related, but they're not perfectly related. Okay. Use the appropriate index that represents the risk characteristics of the portfolio being measured. Really simple example on this. If I had an international stock index, an international stock portfolio, I am not going to use the S&P 500 as my benchmark. Why? Because it doesn't make sense. I'm going to use an international index like the MSCI EFA index as my index because I have an international portfolio. If I have a domestic portfolio, that's when I'll use the S&P 500 as my benchmark. Why? Because I want an apples for apples comparison. I don't want to have an international portfolio and then have my benchmark be based on only U.S. companies. That would be like having my Honda Civic be compared to a Maserati. You could compare them. They both drive. They're both on the road. But guess what? They're in two separate classes. Okay. A little bit more information. You can do this on your own. Gives a little bit more detail on just the MSCI indexes, Standard & Poor's, SEC, Dow Jones, and Yahoo Finance. Yahoo Finance is one of my favorite websites for financial services information. And that's it for this chapter. As I promised, I was a little bit quicker in going through this chapter. Hope you enjoyed it, and we'll see you next chapter.